and we'll load up gold, and I'm going to reprint this over to YouTube. So I will say, we'll go over gold now. Don't forget to get my free training underneath this video. Don't forget to like, share, comment, and subscribe. I'm posting videos constantly all the time, doing multi-time analysis in the way that I do to be accurate myself and trade each day. So gold is really interesting at the moment, and I'll tell you why. It is because at this point you have seen further drip on your third candle down. Okay, so you've come from about 2009, $2008, and you've dropped about 30 bucks or just over. Not terribly far, but we did speak about what that really means for you if you are trading gold. Now, I've said many times, I've gone over the history of where we were with it, but essentially we called it long here. We called it long nearer the start of October. We were DCAing in. Of course, as you can see on the chart, or you'll know if you're trading it yourself, that came in line with our stock oscillator, came right down, so we know we've got a low price. We came well off our earliest key moving average at this point, and we came all the way down. So what then happened was an enormous rebound, obviously with what's happening in the world at the moment, and that brought the price up and up and up and up. And you've had very little resistance, very little in the way of pullback since. Okay, and what that's done is it's sustained the price higher and higher and higher. So when your market sentiment changes, that's exactly what you could expect. But I would say, of course, you need to tighten your risk in the event of this happening, because you don't know how far ultimately it's going to go. Now, you do currently have a still fairly high price. The pullback which you're seeing on that rash move is not even really considerable at all. The only thing that could be, and it would be more for scalp traders, you could be scalp long at the moment or hedge long, as many of my members trade. And you've got a little bit of a pullback there. So as the sentiment is so strong, I wouldn't be entirely shocked, really, if that does hold some weight and pull you back up nearer your highs, nearer here. That wouldn't shock me at all. But really, if you're a risk-averse trader, I would just hold off for future longs. Okay, if you're not in the market and you're looking for somewhere to actually buy gold, then I think you need a much further pullback, because what that will do is it will do several things. From a key technical trading perspective, it will take you back to your key moving averages there. And along with that, you've got various levels of price action, which also suit that area of the market. So what you'll probably see if that occurs on your daily particularly is a creep down of your stock oscillator further lower, taking you nearer key technical levels to get long. Okay, it might not be down here, it might be up there. You don't really need your stock oscillator all the way down here, but you just have to ask yourself, would I rather sell when it's high and buy when it's low? Yes, it doesn't mean it's going to happen every time, but it's just a way of gauging the value of the market. If you've got a really high stochastic oscillator, you shouldn't be buying particularly. I know the stock oscillator is high now, which is why I said if you are going to buy this, it's got risk and you're going to have to trade extremely small, because this wouldn't be a shocker. You know, a move down to 1930. That would be more ideal if you wanted to take it long. Now, if you're a short seller and perhaps you've already got it short, I would consider locking in your gains. This doesn't look terribly convincing, this last 4-hour candle. Doesn't look like it's got a lot of long side weight. So you could consider perhaps having a trailing stop or an in-the-money stop loss, or whatever you want to call it, just a little bit higher up above that candle wick, so that if you do find that this just crumbles down, which looks reasonably likely given the way the candle's forming now and the weakness in the market, you'll extend your gains as it falls. So we did call it short. I have said it's short for a long time around here. Okay, last time I said kill your shorts and reshort above this high. So if you've done that and you're well in profit, you could just close it entirely. But I would probably consider locking in gains, just because of the market sentiment and just because of the fact that you're coming to this level of key support. Okay, so what you can see here is price rejection in the market, and it's where you've previously seen rebounds. Okay, so that all adds into the potential for rebounding market now. But you can see down here is so much more preferable, simply because you've got such a key tech zone. The more strength in a technical zone, if you like, the more valid it is for alongside entry and as something to trade. So that's why I say that. Looking long down there, if you did want to short, my bias remains similar to what I was saying before about previous highs. But I would say generally, if you put your market you put your charts to the weekly, again, anything higher up in here is always going to constitute short entry. So if you're risk averse, I would need a larger bounce up here and then I would short. Don't buy it and hold it till then. I wouldn't advise doing that. It's too high to buy. You are at the highs. You shouldn't be buying high prices as a normal means of trading. But anything from 2006 to 2040 for me, this area is where you can scale into the market short. And it's because you've seen it short so many times. Okay, don't be a dummy. Just look. Short here, short there, short there. What are you going to do this time? Are you going to buy? Why would you do it? If you're someone who's saying, oh, I think the market's going to go up and up and up forever with no stop, if you said it there, you would have been terribly wrong. If you said it there, you would have been awfully wrong. And if you said it there, you would have been really wrong as well. If you said it there, there, and you get the picture. Okay, after long rallies, you get falls. That is simply how markets work. It is not sustainable for any asset really to go up forever because people like money. People like money and they liquidate their positions. They don't want to hold. What is the point in buying something and never selling it? You can't make any money doing that. Even if the value goes up, if you do not ever sell, it's impossible for you to make money. So you've got to sell your asset at some point. Okay. So a repush above the previous highs into that level of key resistance would be ideal. You may find that your stock oscillator is sustained at this point, so it might trickle along this over bought area on the weekly and then keep going up. The key lesson there is to not be one of those people who thinks that that cannot keep going up, okay? This can't keep going up because when you've got this market sentiment like now, like you've had various times before, people get scared, people get really worried, and they hold on and on and on and on. Now, it's worth noting as well, with the employment data in the US and also the Fed decision later, you've got ISM manufacturing PMI for October as well. You might find that those results cause a change in the market too. So if you are trading things like this, I would just reflect on that US news and just make sure that you're not over leveraging because you think the Fed is going to do this, the Fed's going to do that. Someone said to me actually, and I get this all the time. People in my academy and out of my academy always say, I'm going to hold off because of this news event. I think that the Fed is going to do this and that's going to cause this to happen to the price. And I said, okay, what if you're wrong? What if the market doesn't fall? What if it goes up? Or vice versa? And they say, I didn't think of that. You've just got to understand that if you're trying to guess what economic analysts are doing, um, what quantifies your expertise? You've got to ask yourself, have you studied the economy? Are you an economist? Even if you are an economist, it doesn't really matter. It doesn't put you ahead because you don't know what is going to happen. That is a simple fact. Nobody knows what the Fed is going to say or do, like to the point or specifically. You can only infer so far. Now that's one part of it, but the other part of it is what they say is going to do to the markets. Nobody knows that either. So you don't know what they're going to say to the absolute letter. You don't know how the market's going to react to it. Okay, they could say something great and the markets plummet. They could say something bad and the markets come up. Don't guess it. Okay, I don't know ever what the market is going to do because of a news event. All I can do, and it's exactly in this instance, is say, well, if it comes down here, I'm going to lightly buy it. If it comes up here, I'm going to lightly sell it. I'm going to set my orders and I'm going to wait because that is the best way to do it. You're casting your net so that once the news is out, you're going to catch it. You're going to catch the fish, if you like. There's no point, absolutely no point in trying to guess what the news is going to do because it's an impossible task. And it's just not worth it. Your risk is going to go up and you're going to find your results are massively skewed. So don't do that. So that's gold, of course. As I said, do remember to like, share, comment, subscribe, get my free training underneath the video. It will help you very much greatly.